Welcome back to this special edition of Your Money, How to Speak Money. Never before have savers been awarded so little for stashing their money in a bank account or CD. Is there any place to park your money and make a little interest, to make a little money with your money? From least risky to most risky, here's what it looks like. There's your mattress, of course. It's the least risky, but it's a really bad idea. It's not guaranteed by the federal government, and it won't grow. In fact, with inflation, your money gets less valuable every year that you leave it in here. So what about a bank account? Oh, you know the answer to this. The pro is it's insured by the federal government in case the bank goes belly up to $250,000 per account. The con is you're not getting anything on it, about 0.5% in interest. Unless you have a rockin' online bank, you got a lot of money stashed in a jumbo checking account, or you've combined your savings, your checking, and your investment accounts, you aren't getting squat. Your next option, slightly more risky though, but with more potential for a reward, stocks with dividends. The company pays you interest on each share that you own. One example, Altria, the parent company of cigarette maker Philip Morris. It's going to pay you 6% to hold its shares. Other companies, Merck and Pfizer, they also pay dividends of almost 5%. Hundreds of companies do this. But to keep your risk low, stick with large cap, blue chip stocks with a history of raising dividends over several years. Now, with more risk comes more reward. How about high yield exchange traded funds, or ETFs? It's another option. With these, you can pick a basket of stocks. These are some of the really most popular high yielding ETFs from Wisdom Tree, Vanguard, and Standard & Poor's. And finally, high-yield mutual funds. When you contribute money to a mutual fund, along with thousands of other small investors, a fund manager buys stocks, bonds, and other securities with that money. These are often ranked by the fees and performance of the fund managers. PIMCO and Fidelity are some of the top-ranked funds. Allie?
It's very hard that the people who were the most responsible and worst savers, and now in the light of this recession we've gone through, want to be the most responsible, will not be rewarded for that at all. And it's unfair. Yep. It's terrible, but it is the way it is. Doug Flynn, you've got people who come to you with these questions. They say, I don't have the appetite for more risk. Mm-hmm. What do you tell them? Well, it's a good point. I think part of it is, in the book, we have a detailed risk profile, and I think that's something that it deserves to be looked at. I think you might have more appetite for risk than you think with goals that might be 20 or 30 years away. Goals that you might have a year or two away, you shouldn't have anything to do with the stock market. But people tend to put everything in one big bucket and expect it to be the portfolio. I'm going to get in the market, I'm going to get out of the market. If you separate into your goals, you can start thinking more like, hey, long-term goals I can be a little more aggressive with than maybe I'm comfortable with, and I'll learn to become comfortable. But short-term things, savings and money I need tomorrow, should have nothing to do with that, so I don't worry about if the market goes down 20%. Right. So you have to start looking at it and thinking about it that way. That's the beginning of developing a portfolio and getting comfortable with investing. Two bad things can happen to people when they start investing. You either do really, really well, or you do really, really poorly. And if you do really well, you tend to take bigger and bigger bets until the whole thing caves in. Or if you do really, really poorly, like the people who invested the last 10 years in the market, they've been burned, they haven't made anything, they might shy away from investing for the rest of their lives. That's not going to do it either.
Interest rates are so low. They are so low, and that's because the government is trying to the Fed is trying to spur economic activity. They're trying to get people to borrow, and they're trying to get people to take mortgages. If you're on a fixed income, you're not getting any money for your money. You know, you're not getting rewarded for saving, and that just really hurts a lot of people who don't have a big means.
It is, but you have to understand that most of the mistakes are not made on the interest rates, they're made on behavioral mistakes. Okay. And for example, if we're talking about an older person who's put money in, you said, you know, let's move them into high yield, they don't realize that if interest rates start going up, their principal will fall. Right. Now, they're getting the interest, they're getting the dividends, but the problem is they're looking at their statement at the end of the month, and they've lost $20,000. Right. They get scared, pull the money out.
And book the loss.
And they book the loss. And so what's happening is it's all based on emotion. We know by dollar bar that says that most people will earn a lot less in bond funds or stock funds because they get scared when the market goes down, just so we have right now, and they're sitting, and they do have money underneath the mattress. I know a lot of people have money in the mattress right now. Let me ask you this. Doug has a practice where he deals with a lot of people who they may not have talked to each other about money as much, but they generally have a little bit of a level of sophistication about money. You and Lynette, you deal with a lot of people who this is their first foray into having a conversation with somebody about their finances.
how do you approach this differently? Because generally speaking, the less sophistication and experience and comfort you have with money, the more conservative you are likely to be.
That's right. You know, Lou brought up a point earlier that I think is very relevant here. He said process versus products.
Right.
And that's one of the things that I tell people who are novices, frankly, to the stock market or the world of investing. Do not worry about specific investment products. What's the hot stock of 2011 or for 2012? What's the best mutual fund? That's the wrong focus. You should be thinking about the process of investing, which is simply, in my view, a 5-phase process. Strategizing to meet your own personal goals and needs, buying the right investments, holding and monitoring the assets in your portfolio, selling in a judicious manner in a tax-efficient way for the right reason with a sell discipline or a sell strategy behind it.
Right.
And then the 5th phase of the investing process is working effectively with financial advisors. Your CPA, your accountant,
that's great
your
advice,
advisor,
but just remember, you said they're conservative. I think this is where people get ripped off. This is where I think there are a lot of financial predators going on, people saying, you're getting 1% of the bank, put money in this gold account right now.
Right.
You're seeing a lot of gold commercials, and there's a lot of financial predators for the novices, people who are just starting to learn. And you have to be really careful.
For people who are afraid.
Well, but they don't have enough, and so when you don't have enough, you want to all of a sudden win the lottery. These are the people who are standing in line to win the lotto tickets, and all of a sudden they want to have nothing and make a lot of money the very next day, and so they get greedy, right? Greed or fear, and then they lose a lot of money. So you have to be very careful not to.
So the strategy part of what Lynette said is good, and I think we all agree with that. I guess that's kind of our point. If you understand a little bit more about how to speak money, you will simply be less intimidated.
Right. That's where you have to go basic. Educate yourself. Buy the book, How to Speak Money. You didn't pay me to say that. But the important thing is, finance is not sexy, and a lot of people will bypass that in the newspapers, the magazines. Instead of reading the vampire novels all the time like I do, go out and get yourself a book on finance and get educated, and therefore you'll be a little bit more into the comfort zone and understand a little bit better.
I appreciate that. You know, I would add one thing, that you speak money, you speak the language slightly differently depending on your age, and that's in your investments, and depending on what you need that money to do for you. The language you're speaking, or the way you hear money when you're 20 is different than at 40, is different at 60. And that's a really important, it has to be a conversation that's evolving throughout your working and your retirement
And
years.
in the book, we've got an entire chapter dedicated to being just a quiz for you, so that this isn't a general conversation. This is something you go through it and you pick every one of those things, and it tells you where you fall into that whole gauge. This is a great conversation. We wish we could just keep on talking about it. We hope it's been helpful to you. Jeff Gardere, clinical psychologist, thank you for joining us.
Pleasure.
Doug Flynn, a pleasure to see you, financial planner with Flynn Zito Capital Management. Lynette Khalfani-Cox, the founder of AskTheMoneyCoach.com, and Louis Barajas, a personal wealth advisor. Thanks to all of you for being with us.
Thank you.
Well, fights over money may be the leading cause of divorce in this country, but Christine and I have made it through this book and this hour, and we still want to work together.
Hypothetically speaking, we've made it together through the hour. You're right. Since you made it this far with us, you should be a lot more confident, we hope, about your own financial situation. It was a lot to digest in 1 hour, so coming up, Allie and I will each share the one thing we feel you need to make sure you know that you learned when it comes to how to speak money.